Welcome to the tutorial on business ethics. Today the chapter is ethical decision making, focusing on the corporate governance, accounting and finance. We can see there are two quotes related to this chapter. One quote from Greg Smith. The quote is, "It astounds me how little senior management gets a basic truth. If clients don't trust you, they will eventually stop doing business with you. It doesn't matter how smart you are." That means whenever the customer don't trust you or don't trust any company, in that case, they will not do any transaction with you. The manager should be aware about this issue. The second quote is taken from Peter Drucker, and the quote is, "Whenever an institution malfunctions as consistently as boards of directors have in nearly every major fiasco of the last 40 or 50 years, it is futile to blame mean. It is the institution that malfunctions." That means whenever there is a failure faced by any company, in that case, we shouldn't blame the responsible mean, because the main reason for that failures is the malfunction, and malfunction arises from the lack of corporate governance. And this chapter will focus on the corporate governance and accounting and finance for an ethical consideration in ethical decision making. From the previous chapters of business ethics course, we have learned various types of scandals of business organization. Here we can see some examples: Enron, WorldCom, Tyco, Rite Aid, Sunbeam, Waste Management, Health South, Global Crossing, Arthur Anderson, Ernst & Young, KPMG, JP Morgan, Merrill, Lynch, Morgan Stanley, Citigroup, etc. These are the corporate scandals for which the main reason is absence of corporate governance and responsibility. That means the center of those scandals were the reasons of not having corporate governance and responsibility. Significant cases of financial fraud, mismanagement, criminality and deceit were not only tolerated but also endorsed by those people in the highest levels of corporate governance who should have been standing guard against such unethical and illegal behavior. That means if there were corporate governance in those corporations, in that case they could act as a guard against the unethical and illegal behavior. Since there were absent of corporate governance, there were fraud and mismanagement, and ultimately those companies faced disasters in their operation. If any company don't have corporate governance structure, in that case that company may face ethical and business failures, because due to the absence of corporate governance, there might be misconduct in financial and accounting activities. In that case, there might be manipulation of special purpose entities to defraud lenders, to cooking the books, to instituting questionable tax dodges, to allowing investment decisions to warp objectivity of investment research and advice, to Ponzi schemes, to insider trading, to excessive pay for executives, to dicey investments in subprime mortgages and hedge funds, to risky credit default swaps, to fraudulent reporting of loan rates. So these are the misconduct or manipulation which may arise from the unethical behavior of financial and accounting professionals. And this financial and accounting misconduct arise from the lack of corporate governance structure. Ultimately, there will be a ethical and business failures for the corruptions. What is corporate governance? Corporate governance is a structure by which corporations are managed, directed, and controlled toward the objectives of fairness, accountability, and transparency. The structure generally will determine the relationship between the board of directors, the shareholders or owners of the firm, and the firm's executive or management. That means corporate governance shows the relationship between the various stakeholders of a company, and the main purpose of corporate governance is to ensure fairness, accountability, and transparency. And this corporate structure shows the ways or process to manage or direct or control the business for achieving the objectives of the business. But if the auditors are not independent, and if the accountants don't perform the responsibilities in a fair way, in that case, the business system may face the failure. That's why the main focus of this tutorial will be on the accounting and financial activities, as well as the main theme, corporate governance. Role of accountants and other professionals as gatekeepers. Here the gatekeepers means the watchdogs or the persons who will monitor the ethics and laws of an organization. Accountants, auditors, financial analysts, attorneys, board of directors, industrial experts can be thought of as gatekeepers or watchdogs, in that their role is to ensure that those who enter into the marketplace are playing by the rules and conforming to the very conditions that ensure the market functions as it is supposed to function. That means these are the professionals who will monitor the activities in a company, and they will ensure that the stakeholders are performing their activities under the rules and by complying the laws. All the participants rely on these gatekeepers. I mean, the stakeholders or participants of a company rely on the assurance of those professionals. And here the participants or stakeholders means the investors, board of directors, management, and the bankers. Auditors verify a company's financial statements so that investors' decisions are free from fraud and deception. Analysts evaluate a company's financial prospects or credit worthiness so that banks and investors can make informed decisions. Attorneys or lawyers ensure that decisions and transactions conform to the law. And sometimes the experts or engineers of a company can also have a role to ensure that the products or services are safe and legal. And the board of directors function as a intermediaries between the company's stockholders and its executives. That's why they should guarantee that executives act on behalf of the stockholders' interest. So these are the responsibilities of various professionals, auditors, analysts, attorneys, the expert and the board of directors. If these professionals perform their due activities, if they work as a watchdog or a monitor, in that case there would be a good corporate governance. But most of the cases, the professionals face conflicts of interest while performing their activities as a gatekeepers or intermediaries. How conflicts of interest can arise for business professionals? A conflict of interest exists where a person holds a position of trust that requires that she or he exercise judgment on behalf of others, but where her or his personal interest and or obligations conflict with those of others. That means whenever any professional face difficulties due to the clash between the professional duties and his or her personal interest, in that case the conflict of interest arises. Here is an example. The financial planner is responsible to serve the clients, but the financial planner is hired by the brokerage house. In that case, they have a fiduciary duties to serve the clients, but sometimes they may face difficulties due to the conflict of interest arises from the professional duties and personal interest. And here fiduciary duties means a legal duty to act on behalf of or in the interest of another. The certified public accountants are hired and paid by the management team, but they have a responsibility or professional duties to serve the stockholder, and that's why, since they are paid by the management but they are supposed to serve the stockholders, in that case there might be conflicts between professional duties and self-interest. Due to conflict of interest, the agency problem may arise. Here, agency problem means generally the main owner of a company are the stockholders, but the stockholders don't operate the business. In that case, the board of directors assign the responsibility of operating the business to the management. In that case, if the management don't serve the purpose of the stockholders, the agency problem arise. Due to the agency problem, there might be conflict of interest in the management or the professionals. As per example, the auditors are paid by the clients, but they are supposed to serve the stockholders or equity holders or the owners. Since they are paid by the management but they need to serve to the stockholders, there might be conflict between the professional duties and the personal interest. In that case, there is a necessity to make structural changes. The first change could be the board of directors should hire and work with the auditors, because the auditors are more likely reporting on the management activities rather than those of the board. Perhaps public accounting somehow ought to be paid by public fees, and perhaps legal protection and sanctions ought to be created to shield professionals from conflicts of interest. These are the changes that need to be introduced in the structure of an organization, in the corporate governance, so that the professionals can act their professional duties without facing any conflict with the personal interest. the requirements of the Sarbanes-Oxley Act. Whenever there is a corporate scandals, the investors lost their confidence. In the history of scandals, the Enron scandals was the biggest scandal due to the fraud by the accounting and auditing professionals. To protect such type of fraud or scandals, the US Congress passed the Public Accounting Reform and Investor Protection Act, which is commonly known as Sarbanes-Oxley Act, and the short form of Sarbanes-Oxley Act is SOX or Sarb-Ox. However, the main purpose of this Sarbanes-Oxley Act is to regulate financial reporting and auditing of publicly traded companies in the United States. However, this Sarbanes-Oxley Act involves the high cost of compliance. That's why it would be a burden for the small companies. The Sarbanes-Oxley Act is a law to protect the interest of the investors. There are provisions by which it will create an impact on corporate governance and boards. Sarbanes-Oxley Act prohibits the auditors to perform consulting activities. Whenever the auditors perform consulting activities, there might be conflict of interest because the main purpose of assigning auditors is to ensure that the financial reporting are accurate. But if they serve as a consultant, in that case, they may face conflict of interest. And in the Sarbanes-Oxley Act, there is a prohibition for the auditors not to serve as a consultant. And another requirement is the audit committees should have independence in taking their decisions and providing opinion. And there is another requirement under the Sarbanes-Oxley Act, that is the attorneys, the lawyer, should report for any wrongdoings. And in case of internal control, the Sarbanes-Oxley Act requires that the management file an internal control report with its annual report. And in this internal control report, they will show how the business or the organization maintain control on various aspects to ensure fairness and transparency. And under the Sarbanes-Oxley Act, there should be codes of ethics for senior financial officers. And in the audit committee, there should be a financial expert so that they can identify the frauds easily. The COSO framework. The COSO means Committee of Sponsoring Organizations. This COSO framework focuses on internal controls and governance to achieve the business objective. Internal control is a mechanism or a process which is established internally by the board of directors and management to ensure compliance with financial reporting laws and regulations. If there is a good internal control and if there is a good corporate governance, the business can achieve the objectives for all stakeholders. That's why the Committee of Sponsoring Organizations established a framework for internal controls and governance. And this COSO is a voluntary collaboration of professional audit and accounting organizations. And the main purpose of this COSO is to improve the financial reporting through the combination of controls and governance standards called the Internal Control Integrated Framework. COSO framework focuses on control structure, and in the control structure there are some elements which are control environment, risk assessment, control activities, information and communications, ongoing monitoring. Control environment is the tone of an organization which influences the control consciousness of its people. And there should be a risk assessment process, otherwise there will be a hindrance to achieve the corporate objectives. And for control activities, there should be policies and procedures that support the control environment. And information and communication are essential to support the control environment through fair and truthful transmission of information. And ongoing monitoring is an essential issue which can be used for assessing the capabilities and to uncover the vulnerabilities for any potential risk. What is internal control? Internal control is a process effected by the entity's board of directors, management and other personnel designed to provide reasonable assurance regarding the achievement of objectives in the following categories: effectiveness and efficiency in operations, reliability of financial reporting, and compliance with applicable laws and regulations. By this internal control, we can ensure these issues: effective and efficient operations, reliable financial reporting, and compliance with the laws and regulations. And what is control environment? Control environment refers to cultural issues such as integrity, ethical values, competence, philosophy, and operating styles. This internal control and control environment are two elements under the COSO framework. We have learned that under the COSO framework there is a control structure, and under the control structure there are 5 elements. Among those 5 elements, the 2 elements are internal control and control environment. This COSO framework addresses the corporate culture in a quasi-regulatory framework in recognition of its significant impact on the satisfaction of organizational objectives. The control environment and the means by which ethics and culture can impact that environment. Already we have learned that control environment is an element under control structure. Control environment sets the tone of an organization, influencing the control consciousness of its people. And to ensure control environment, we need to introduce the following issues such as division of authority, reporting structures, roles and responsibilities, the presence of a code of conduct, a reporting structure. By introducing these issues, we can ensure a good control environment, and by ensuring a good control environment, we can ensure a good control structure, and by ensuring a good control structure, we can ensure the corporate governance, and by ensuring a corporate governance, we can ensure that the organization will achieve the objectives for various stakeholders. In chapter 4 of this business ethics course, we have learned about corporate culture, and we are aware that there are 2 factors in a corporate culture. One is internal factors, another one is external factors. And from this tutorial, we have learned that we can ensure the accountability of the internal factors by following the COSO framework, and we can ensure the accountability of the external factors by following the Sarbanes-Oxley requirements. And the accountability can be maintained by the executives and boards, internal audit, and the compliance professional. And their main purpose should be to ensure transparency, accountability, and to prevent misconduct. And to ensure all of these issues, there should be a unified corporate culture. Legal obligations of a member of a board of directors. Already we have learned that there are some reasons for corporate failures, from which one reason would be a failure on the part of corporate boards. If the board of directors don't perform their monitoring activities on the management, there might be situations for which there will be a corporate failures. And another issue is, if the government fail to impose high expectations of accountability on the board of directors, in that case there might be situation for corporate failures. That means the board of directors has a fiduciary duty to guard the best interest of the firm itself. The board of directors have three types of duties: the duty of care, the duty of good faith, the duty of loyalty. The duty of care involves the exercise of reasonable care by the board of directors to ensure that the corporate executives are performing their activities to achieve the objective of the company, and they are performing their activities by complying the law. The duty of good faith is one of the obedience which requires the board of directors to be faithful to the organizational mission. All the activities or all the performance done by the professionals and management should be for achieving the goals and mission of the organization, and the board of directors should monitor all the activities to ensure that the resources are utilizing for achieving the purpose and goals or the mission of the organization. And the duty of loyalty requires faithfulness. A board member must give undivided allegiance whenever making decisions, whenever they are minimizing any conflict of interest, or whenever they are resolving any problems. In that case, they should work for the interest of the organization. They should not indulge any personal gain. All of the decisions should be taken for the best interest of the organization. The board must work with the executives to analyze the incentives for ethical behavior. They should be knowledgeable about the content and operation of the ethics program. They should exercise reasonable oversight, and they should ensure that the business activities are occurring by having the adequate resources, by appropriate level of authority, and the board of directors have direct access to those resources. In order to assess their success, board of directors should evaluate their training and development materials, their governance structure and position descriptions, their individual evaluation process, their methods for bringing individuals onto the board or removing them, and all board policies, procedures and processes, including a code of conduct and conflicts policies. These issues should be evaluated by the board of directors, and these are the legal obligations of a member of a board of directors. In the previous two slides, we have learned about the legal obligations of the board of directors, and in this slide we are going to learn about the ethical obligations of the board of directors. As a social responsibility or ethical responsibility, the board of directors should act as a guardian to prohibit actions to protect the long-term sustainability, and the board of directors should prevent any unethical behavior or unethical acts. Otherwise, the company may face failure, and this is the ethical duties of a member of a board of directors, and these ethical duties can be considered as fiduciary duty to the owners, the stockholders. There should be open conversation to understand the situations of the company. They should know everything, and they should know those things which they don't know. The board of directors should be critical in their inquiries about the corporate vulnerabilities. Here, vulnerabilities means whether there is any risk which could be a cause for business failure. They should evaluate or understand where the company is heading and whether it is realistic that the company will go there. The board of directors should fix a justifiable compensation for the executives to ensure the sustainable growth of the business. Conflicts of interest in financial markets and the ways in which they may be alleviated. Treating the clients fairly and building a reputation for fair dealing may be a finance professional's greatest asset. But somehow, if there is any conflicts, in that case, that conflicts can erode the trust of the clients. That's why public accountants are accountable to the stakeholders. Here the stakeholders means the stockholder and the investment community, and these public accountants should serve in the role of independent contractor to the firms whom they audit. I mean, whenever the public accountants are hired for a company, they should serve as a independent contractor. They should not indulge the personal interest while performing the professional responsibilities. But nowadays, in the accounting practices, there are lots of unethical issues like underreporting income, falsifying documents, allowing or taking questionable deductions, illegally evading income tax, engaging in frauds. And these issues arises whenever the public accountants or the accounting professional faces conflicts due to the personal interest and the professional duties. And to prevent those types of conflicts, there is a need for professional rules. In this slide, I am going to discuss about the causes or the reasons for which conflict of interest arises in the financial markets. And here the financial market means the public accountants or accounting professionals. The reasons or the causes for conflicts in the financial market are the financial relationship between public accounting firms and their audit clients. Generally, the audit clients are hired by the management, but they are hired for serving the stockholders. Since their payments depends on the management, but they need to serve for the stockholders, there might be conflict of interest due to the personal interest to ensure their payments and due to the professional duties to the stockholders. And the second cause is conflicts between services offered by public accounting firms. Sometimes the public accounting firms or the public accountants act as a consulting firm. If they serve as a consulting firm, they will face problems in serving their independent opinion, and for that purpose there might be conflict of interest, because in case of ensuring their consulting fee, they may adopt unfair activities which will hamper in providing expert opinion. And the third cause is the lack of independence and expertise of audit committees. And the fourth reason is self-regulation of accounting professions. Sometimes there is a lack of oversight in the accounting profession. And the fifth reason for which there might be conflict of interest in the financial market, among the accounting professional, is that lack of shareholder activism. Because the investors are the real owners of a company, but they are scattered. That's why they can't act to protect their company, and that responsibility is assigned to the board of directors. In that case, we can say there is a lack of shareholder activism. And the sixth reason is short-term executive greed versus long-term shareholder wealth. Executive compensation package do not create appropriate incentives systems for ethical executive and board decision making. The seventh reason or cause is executive compensation scheme. If the compensation of an executive is related to the performance and with the stock option, in that case they will try to show a good performance by doing any unfair things to achieve the stock options. In that case there may be a conflict of interest. And finally we can see the reason is compensation schemes for security analyst. Investment banking analysts have an interest in sales. This is how they generate the commissions or fees that support their salaries. However, the sale is not always the best possible transaction for the client, generating potential conflicts. So these are the reasons from which there might be conflicts of interest among the accounting professionals or financial markets. The second portion of this topic is how to alleviate or remove or reduce the conflict of interest. To alleviate or to remove the conflict of interest, there should be additional regulation and there should be due notice and separation of research and auditing activities. Auditing should be done for providing expert opinion and research or consulting should be another purpose. Both activities should not be done by one public accountant or one public accounting professional. Since the conflict of interest cannot be removed thoroughly, in that case there is no perfect solution. That's why the investors should use their judgment while taking investment decision. But from the regulator side, there should be adequate response, and that response should come from the individual level, from the government level, and there should be response from the national and international bodies. Conflicts of interest in governance created by excessive executive compensation. Here executive compensation means the salary or other benefits for the higher level executives. Here the governance means corporate governance, and this corporate governance is monitored by the board of directors. But sometimes some or one higher executive act as a chair in the board of directors, and since the board of directors monitor the corporate governance, in that case due to these two roles by one person there might be conflicts of interest, because nowadays the board of directors are providing too much excessive compensation, and for which there is a lots of criticism, because if we compare the salaries of the executive with the salaries of the workers, there would be a huge difference, and that's why there are criticisms, and for which there might be conflicts of interest. The defenders of excessive executive compensation says that lofty compensation serve corporate interest in two ways. They provide an incentive for executive performance, and they serve as a rewards for accomplishments. The previous two reasons for supporting excessive executive compensation are not true, because there are several reasons why executive compensation may evidence a failure of corporate boards to fulfill their fiduciary duties. There are lots of criticism against the excessive executive compensation, and you can see the first criticism is that no correlation between the executive compensation and performance of the management. And the second criticism is there is little evidence that the types of compensation packages described earlier are actually needed as incentives for performance, because the board of directors are providing too much incentive which are not needed for them. And another criticism is that sometimes the executives are provided with the stock options, and whenever any executive have a stock, in that case, to gain from that stock, the executive may adopt unfair activities to increase the value of that stock, and that is another criticism. And further, whenever the compensation is linked to the performance, in that case, the executives try to adopt unfair means to achieve the target for getting the excessive compensation. In that case, they may adopt falsely reporting, which will provide false results. Insider trading and its potential for unethical behavior. What is insider trading? Insider trading refers generally to buying or selling a security, the stock or share, in breach of a fiduciary duty or other relationship of trust and confidence, while in possession of material non-public information about the security. Here the security means any stock or share. Whenever any person have a secret information of any company, if that person use that information to unethically gain by purchasing or selling share, in that case, that type of trading of share and stock can be considered as insider trading. Insider trading violations may also include tipping such information. Tipping means, suppose you are the internal stakeholder of a company and you know a secret information of a company, and if you provide this information to others people, by which those people will gain unethical profit, in that case, that would be considered as tipping such information. Insider trading violation may also include securities trading by the person tipped, securities trading by those who misappropriate such information. So these are the three types of issues by which insider trading violation may occur. Illegal insider trading also occurs when corporate insiders provide tips to family members, friends or others, and those parties buy or sell the company's stock based on that information. Whenever as an internal person of a company, if you provide any tips, secret information to your family members or friends, and if the family members or friends buy or sell the company's stock or share based on that information, that would be considered as illegal insider trading. Trading of share after getting the insider news, and that type of insider trading is unethical because the general investors don't know the reason of huge amount of buy or sell of any share. In that case, they will face loss. Already due to insider trading, some people will get benefit. That's why this is unethical. Since insider trading undermines investors' confidence in the fairness and integrity of the securities market, that's why the commission, the Securities and Exchange Commission, has treated the detection and prosecution of insider trading violations as one of its enforcement priorities. Insider trading may also be based on a claim of unethical misappropriation of proprietary knowledge. That's why the law surrounding this insider trading should protect the confidential information, proprietary information, intellectual properties. That's why the commission, the Securities and Exchange Commission, has a fiduciary duties to protect the insider tradings so that this insider trading does not destroy the confidence of the general investors. That is why this insider trading can be considered as unfair and unethical. That's why The insider trading should be prevented by ensuring the corporate governance from the Securities and Exchange Commission. However, the summary of this chapter is that if corporate governance can be ensured, in that case, we can prevent various types of business failures which arises from the unethical activities from the accounting and financial professional, because the main responsibility of the accounting and financial professionals are to provide quality opinion about the truthfulness of the financial reporting. That's why there should be a good corporate governance to prevent any types of business failures. Thank you.